The discounted cash flow model uses current free cash flows of a company, extrapolating that into the future, then calculates the terminal value of the company, discounting that to the present value, and then using the shares outstanding to calculate the price per share. In this video, I'm going to show you how to calculate this for yourself with an example that I will walk through, showing you where to get the information. Let's get into it. So here I have the model calculating the free cash flow for Microsoft. I took the free cash flow for the past 5 years. This then calculates the growth over those years and gives me the average here. This growth rate here is a reasonable estimate that they may not grow as fast as they did in the past, but also takes into account the predictions for future growth laid out by the CEO. Satya Nadella has stated that he believes Microsoft will grow their revenue to $500 billion a year by 2030. So using this number and the current free cash flow revenue percentage, by 2030 they should have $160 billion in free cash flow, which is roughly 14% growth per year. This next part here is the extrapolation. This takes the most recent cash flow figure and increases it by the growth rate, and then gets to the 10th year, which is where we do the terminal value calculation. On a basic level, this uses the growth rate and the discount rate to calculate the terminal growth of the company if they continue at the current rate of growth. Then we calculate the present value of the free cash flows. This discounts the free cash flows based on Fed inflation targets, which at the moment is around 3%, and the 3-month Treasury bill interest rate, which is the risk-free rate of return. Almost like this is the return you could get if you did not invest in this company. This is the time value of money, and we need to take this into account to get the current value. Then we sum the future free cash flows and sum this with the current cash and debt. This gives us the total equity value, and then we divide that by the number of shares, which will give us the discounted cash flow price per share. This is quite a simple model, as we are not taking into account many variables, so it is to be taken with a grain of salt. This can also vary wildly if the growth rate estimate changes, and in the current economic climate, it's hard to estimate the discount rate as inflation has been so rampant in recent years, and the 3-month Treasury bill interest rate has increased quite significantly. So let's take a look at another example, and I can show you where to find the variables that we need. This example here I've set up to be Google. What we're going to do now is we're going to go and take a look at Google's balance sheet and Google's free cash flow to get the free cash flows and then the current cash and the current total debt. So here I'm using Morningstar to have a look at the financial statements. If we come over to financials and then cash flow, at the bottom we'll find the free cash flow. So now if I go and enter those onto the spreadsheet, so now that we've got the free cash flow onto the spreadsheet, we can see the growth rate year to year, and we can see in 2022 it dropped off by 10%, and we can see here that the average growth rate is actually sitting at 30%, which is ridiculously high, and already that calculates the future free cash flows and the present value of the future free cash flows, but there's no growth rate entered in there, so we need to put a growth rate in which seems reasonable for the company. Now I don't have any estimate on what the revenue is going to be. I haven't looked at what Google is estimating for their growth, but if we just assume that their average growth rate is 30% and they've dropped off recently, maybe we can take their average at 30% and just drop it down to 25%. So if we put 25% here, we can see that their terminal value is sitting at 3.38 trillion, which is actually quite high. But yeah, let's go and have a look at their current cash and their total debt. So if we come back to Morningstar, we can see here we go onto the balance sheet, and we will find down here we'll have their current debt, and then they'll have their long-term debt. So if we go ahead and enter their long-term debt into the spreadsheet, which is just going to be this figure here, and then up here we can see the cash and cash equivalents, which is what we're looking for, is around 22 billion. So we've entered those into the spreadsheet. We're still missing one component, which is the shares outstanding. Let's go, all we got to do is really just go and Google that. So here we can see that it's at 12 billion. So we're gonna enter in the value at 12,781, which gives us the discounted cash flow price per share of $197.50. So you'll notice that all of these figures are actually in millions, and here is in millions as well. So you can actually see that here is actually 3.4 trillion is the terminal value, not 3.4 million or 3.4 billion, it's 3.4 trillion. And the shares outstanding were 12.78 billion, but obviously I've divided them by a million to get us the correct value here. Now, if we were to change the growth rate to say 20%, you can see that the price per share has actually dropped down a little bit. And that's due to the fact that they're not going to be growing as much, so their total equity value at the end, or their terminal value, is actually gone down. But if I were to put this at around 9.5%, you can see it's gone up wildly. And that's because the calculation actually isn't as accurate as you'd like it to be. But that's because the discount rate is quite high. So if we put the growth rate to 15%, you can see that it's at 175. But it's 25%, it's 197. As you can see, this model isn't actually as accurate as you'd like it to be. It is based on an estimate. It's not perfect. If you can get the CEO to tell you that they want their growth rate to be 10% a year, then great. So I hope you found this video helpful. I will probably be putting this spreadsheet onto my website so that you can get it, download it for free. If you need any more information about the discount and cash flow model, leave a comment below and I'll reply to you. That is the end of the video. Thank you for watching this far into the video. If you like the video, give it a thumbs up. Any suggestions on improvements to the video content or ideas for content going forward, please leave a comment below and I'll give you a reply. Also, you can check out the investment dashboard at the link in the description, along with a range of other spreadsheets that I've built.